Ken Flag. Today's date, 2/19/2011. And this one's done for Ken Flag and David MMT and all other MMTs. However, what we want to show you here, now it's an April 13/20 put. Remember that the 13/20 put option, S&P closed at 13.43. This is a 13/20 call that's in the money, so it's in the money. This is out of the money based on the strike prices there. What we are going to show you is that the lows of the contract, when they were kind of written back in 1/19 of 2011, the low was 20.50. We've more than doubled here. And we're getting top-ended, and we're up there in the inflated zone. And we can continue to go a little higher there. But on the same hand, when these contracts, and this contract right here in the S&P, right down here, take a look, on 2/7, the low, the high was 35.45. Right now, down here, you can take a look and see that this particular contract, the low was 22.50. The imbalance ratio, inflated, deflated, we can get a little bit more deflated depending on the Tuesday morning gap. We're overbought on the S&P. It's a long-term play, but let me show you what you want to see. 36,000 contracts traded. Look at here. On the 13/20 put option, prior, there was only 89 contracts. Nobody was thinking about getting any bear move on for a reversal at all. It all came right here on Friday. Big bearish move for the 4/16/2011 contract. That's that 13/20 put option. That's this chart right there. And it's at all-time lows. And it can go a little lower based on pre-market gaps in the S&P 500. What I do want to show on the same hand is that the 13/20 call, which is the other side of the trade, it looks like the bull was not bullish. There was only one contract traded of the 13/20 call that's in the money right here. The total open interest is 37.41. If you take a look at the two, that huge, powerful options institutional traders are moving big for a correction. Why? Because SMF has told it clearly that there's going to be a time for a nice pullback. The thing that the MMTs are going to learn when trading index options is, why does this have to fall in value and why does this have to go up in value? So one thing about trading the S&P when you're holding it overnight on put and calls is that you usually have a gap up or a gap down. So let's say Tuesday, if we gap down, naturally that's going to gap up in value. This would gap down in value. We're going to look on how to square our entries. This particular contract is what we call the frontline month. March contracts start trading Tuesday. That's the inline month. The outline month is the April contract. Okay? And you can see how oversold this is and how overbought that is. Now, we will use the daily movement on the S&P 500. One of the things about trading these contracts is understanding what's happening in that S&P 500. If the financials aren't going to go higher, well then guess what? S&P is going to top out. It's going to take, and if the transports and the financials both start to correct, well then naturally the S&P will go down in value, and these will go up in value, and these will go down in value. So what we're going to be doing in our trade management is the imbalances on these index options, how to trade them, how to hedge them. And once again, MMTs, this is not a public model. Our model is a floor exchange model, what the exchange, what market makers do in the pit there, and how they're going to readjust their book. Nobody thinks there's a correction coming, except for Friday. They really believe it, the big money, because you went from the total open interest of 89 to 36,000 traded.